Well, Aramco's explosive IPO is a standalone in a sea of red for energy. Really, it's obviously, as Mark just said, worst performing sector of the year, worst performing of the decade. And check this out, though. This is unusual. A very interesting divergence is happening. This is crude oil versus the XOP, one of the bigger energy oil and gas ETFs. The XOP is down 20% this year. Crude oil, though, is up 30% this year. Normally, they trade together. Not so this year. Let's find out where this may go and get off the charts with Mark Newton of Newton Advisors. Mark.
Thanks, Brian. Yeah, it's still difficult to make a case for buying energy here. I know it's fashionable as you get into end of the year to think, okay, mean reversion, the sector has to snap back just because it's oversold. But you see the persistent downtrend that's been in place in XOP, down 20% this year, down over 50% from last September. So in order to at least have a little bit of hope, you really need to get up over $22. But really anything down under this would suggest that you could actually fall into the mid-teens. And so it's important to really put the charts into perspective and the price action. You look at a longer-term chart just going back since 2016 where crude bottomed, and this is substantial. This is also right down near current levels, and actually prices now are under this level. So anything under 20, and I would argue that this actually can still go lower. If we see signs of crude breaking out above 60, the production cuts, if Iraq falls through and actually starts to cut as planned, if demand comes back, crude starts to move up, I think we can see a bounce in energy. I just don't see much technically that would suggest that it's there just yet. The downtrend has been very persistent. With that in mind, there are a few stocks that I would suggest that can be bought here, and I think you really have to be selective. Until we see that mean reversion snap back, it's tough to buy the laggards. You really have to stick with the stocks that have been strong. Phillips 66 is one of these. It's had a pretty persistent uptrend over the last 6 to 8 months of this year. I know it's not a long time. Last September was where these former highs were. Now it's pulled back over the last few weeks right to a level that I actually like buying into this. So former highs should represent support. 105 to 110, you can buy this. Think that it gets back to these highs near 123. The other one I like is ConocoPhillips. Okay, this also has shown some recent signs of actually improving of late. You've actually snapped this one-year downtrend. The stock is actually performing relatively better. If anything, it's a classic case of needing to be selective in this sector. Everybody wants to look at the Schlumbergers and the Halliburtons. Of course, the XLE has the rich dividend names, but in general, energy's been a tough place. And until we see signs of this snapping back, technically you need to see a little bit of evidence. So still proper to avoid it.
Mark, are Conoco and PSX Phillips, are those good-looking charts, or are they just the best-looking charts in the terrible neighborhood of energy?
I would argue that both of these are some that you can buy, but yes, within energy, these are really ones that stand out. I mean, PSX would be one that I would personally put money to work, 105 to 110, and really I would take a look at Conoco as well. But you have to have tight stops in a group like energy, where any sign of failure, obviously with the production cuts, and you start to see crude sell back off, and if anything, that could affect this sector. So it's just been a difficult trade.
Yeah, it really has. Debt, $654 total billion in gross debt across this space on $71 billion in net income, Guy Adami.
You know the space cold, Brian.
I like
Sullivan. I mean, if the TV thing doesn't work out for you, I'm not suggesting that it won't.
Well, 22 years later.
I mean, you could be in the energy space. You'd be killing it. You have to look for
Midland,
it.
wearing overalls and a hat. Oh, I've done that.
By the way, PSX, major double bottom at 83.5, and the chart just illustrated that. But at this 122 level that we just failed at, that's where we topped out in August 2016. 105 is interesting. I actually think this trade's a little bit lower. You buy it, and not for any particular reason other than it's a 50% retracement.
Yep.
Around $100 or so is what
Okay, so as we talked about, debt is a huge story. Most of these companies have terrible credit ratings. They are junk or they are near junk, but there are 6 stocks out there that are currently rated as A or better by S&P. Ready? Here you go. Exxon, it's AAA. Chevron, Schlumberger's A, Halliburton, Baker Hughes, and EOG. 6 with an A credit rating. That's it. Out of 204, well, about 150.
A lot of debt out there.
About 150 that are rated. Any of those you like?
So it's a longer-term play, but I like EOG. And it's not because it's oily, it's because it's gassy.
Best management team in oil and gas, says every single person I talk to.
And I think if you're thinking about what do you buy low, sell high, natural gas for the long term, next 3 to 5 years, you want to be in that space.
Okay. Thank you very much. Good discussion, Mark. Thank you. Fellow Hokie, by the way.